Thank you, Sunil. As you mentioned about the experts, I have expert on the left side, I have expert on the right side. The expertise to the left has been demonstrated, and we will shortly have a turn where the expertise on the right will also be demonstrated. Sunil, as you know, is the vice president of this club, and one of the proposals that he has received is that this dome must be maintained permanently as a monument, as a tourist center, that someday 1500 chartered accountants who were sweating were still awake and studying the provisions of Search and Seizure, listening to me, is the proposal which he has sent. May we now come to Gautam's paper. Gautam has been known to me for long years, more than 3 decades now, and right from the day I met him, I had known him for his perfection. Now he has practiced perfection, so he has even perfected the art of perfection. And when it's a paper presented by him, it's difficult to say anything more than saying that, yes, I agree with you. He is having a paper today on controversies which are raised by the accounting standards vis-a-vis the tax assessment, though the purpose ultimately is computation of income by both the standards as also the tax assessment. Now, though there is a desire to harmonize the two, as the time goes by we find that there is a lot of dichotomy between the income figure which we have as per the standards and the income figure which we have as per the tax assessment, so much so that many a times it would be just impossible to reconcile the two figures. Even amongst these standards, we are likely to have standards which are published by the institute. We have standards which might be published under the Companies Act. We might have standards published by the tax department. We will nowadays also have the US GAAP standards. Then we will have the consolidated accounts, and to top it all, we will have some provisions dealing with the MAT liability, where some other provisions will be found. And we will therefore have different figures, leading to, as Sunil mentioned, we will need specialists to determine income as per the institute standard, as per the tax standard, as per company law standard, and one other figure of what will be the assessable income. But it's here that Gautam has tried to bring out what are the differences and how is the tax assessment likely to be affected. We have some very specific provisions where the legislature itself has created this dichotomy. As a result, the figure of taxable income would be different from what an accountant would feel is the figure of commercial income. We have some inherent differences in the concept. For example, when we come to accounting, we have the concept of income which is maturing, whereas when we come to the tax assessment, we have the income of debt which is becoming due. Income has to become due, has to result into a debt due before it can be regarded as taxable income. And it's here that often we therefore find conflict being resolved by the Supreme Court, where the Supreme Court will have an occasion to debate and answer whether to rely on the accounts and the accountant, or whether the accounting which is done does not present the figure of taxable income. We have some observations of the Supreme Court where we find that at one time the Supreme Court is trusting the accounting profession, whereas it is not trusting the accounting profession on the other occasion. I believe the observations are reconcilable. What the Supreme Court is trying to say is that whether or not income is to be charged or is not to be charged does not depend on an accounting entry. It will need to be resolved as per the provisions of the law, as per tax jurisprudence, as per the canons of taxation. Second, the Supreme Court has said that though normally we will respect the accounting profession in terms of accounting principle, when it comes to a specific provision of the income tax law, we will go by the specific provision of the income tax law. That's what the Supreme Court said in Tuticorin, that the accounting is of no relevance if it is conflicting with a specific perceived provision of the income tax law. But subject to this, the third yardstick would be that if we are not falling into the first two, then we will determine the income as is suggested by the accounting profession. It will be refreshing to hear Gautam's views on this particular aspect of how the Supreme Court perceives the role of the accounting profession. Now there are a number of controversies, each taking standard by standard. Gautam has narrated. Let's first have his views, but at this juncture, maybe I will have only two questions for him. While dealing with the deferred tax standard, he has taken an example of a deferred tax liability, and I believe as part of the slide he has in mind is whether this liability, if it is recognized as such by the accounting profession in the standard, can be validly claimed as a liability for MAT purposes under section 115JB. When Gautam is discussing that, I would also request him to deal with what happens in case of an SSC in whose case in the very first year that he comes across there is a deferred tax asset instead of there being a deferred tax liability. Maybe he may evaluate both the sides keeping in mind the deferred tax asset as also deferred tax liability. How will a man having deferred tax asset try to defend himself? Maybe in the same coin, it may also give some inclination about how to deal with the deferred tax liability and maybe reversal thereof in a later year. Second, Gautam has referred to the aspect of the deep discount bond. And I believe he has in mind the board circular where the concept of maturing income has been taken by the board into account. What the CBDT circular is trying to say, and I would try to divide that into two parts which I believe are objectionable. One is according to the Supreme Court, according to the circular, if I have subscribed to the DDB, then the interest which is pertaining to the first year will be deemed as if it has been received by me at the end of the first year and it has been reinvested by me in the acquisition of a deep discount bond at the end of the year. Therefore, income must be taken into account even in case of a transferable deep discount bond at the end of the first year on a year-to-year basis. The second more objectionable part is that since according to them there is a reinvestment taking place at the end of the year, that acquisition must be regarded as acquisition at the end of the first year, and so construed it will appear as if an admittedly long-term capital asset will try to turn into a short-term because it will have a duration of only 1 year. Whether this reading is the correct reading is what Gautam may tell us. And second, if this circular is regarded as conflicting with the clear provisions of the law, then as the court has clearly said, a circular which is against the provision of law is not binding, and I will always free to debate the matter as it is in accordance with the normal provisions of law. But we are all in very safe hands of Gautam to deal with the controversy. It's not an unsafe situation as one small anecdote goes, where it's a case of a politician who had once gone to attend a conference, and the person who was giving a speech, he as part of the anecdote as a reverence to his mother mentioned that the best years of my life have been spent in the arms of a woman, and he very emotionally said, and that woman happened to be my mother. he paid reverence to his mother. The politician some other day wanted to say the same thing, and he began saying that the best years of my life were spent in the arms of a woman. He forgot what to say next, and he said, "I am sorry, I am not able to remember the name of that woman." But when it comes to Gautam, I can say that the best years of our conference life have been spent when Gautam happens to be the speaker. May I request him to address us?
Chairman Pinakin, Sunil, friends on the dais, ladies and gentlemen, I am obliged to Pinakin for the very kind introduction and to the organizers for giving me this opportunity to discuss a fairly interesting area, the area of the difference between tax and accounting, and how both of them approach the computation of income. I will not take much of your time on the initial parts of it. As Pinakin explained, clearly each of them approaches the subject from their own objective. And the tax authorities don't really want to determine real income. They want to determine real incomes as they understand it, what they consider to be the real income. For example, they would feel that if there is a tax liability for excise, but you have not paid it, why should we allow you a deduction for that? And therefore, there is a section like 43B, which would then say that you will not get a deduction for an unpaid tax liability. So the tax authorities are really trying to determine a fictional income in that sense, and I would not necessarily say a real income. Accountants, on the other hand, claim that they want to assess what one would call the actual or the true commercial profits. But as Pinakin said, accountants can't agree on one accounting standard as to how to determine the true or the correct commercial profits. You have an IAS which says one method is absolutely correct. You have a US GAAP which says something else. You have an Indian accounting standard which says a third thing. So accountants themselves don't know what is true and commercial profit. So each of them is really trying to determine a true or a commercial profit which that accountant thinks is the true commercial profit in that context. And it changes with time. Both these concepts change with time. Accounting is not a static concept. So what you had as a standard a few years back is not necessarily true or the correct measure of commercial profits today, and may not be the correct measure of commercial profits after 5 years. So we don't necessarily expect it to be static. And given this problem, that both of them have different objectives, both of them have difficulty of trying to actually define that ephemeral concept called income. Since we are left with that difficulty, we are bound to face difficulty when we are looking at accounting standards and income tax. And yet, our overall objective is very clear. Our overall objective is to have a system where ultimately, whatever is the accounting profit which is disclosed in my profit and loss account is also my taxable income. Why should we really have a complex system of taxation and computation? And let's leave it to the accountants so long as we have faith that the accountants will do the best of what is currently possible. As I said, they will keep changing from time to time, but they will do what currently seems to be the most accurate way of determining profits. And if that profit is determined, that could be the base for tax purposes. And in that case, we would really be able to harmonize the two. But then commissions have tried to do it. They have tried to make a variety of suggestions. Till today, we have not really succeeded a great deal. There is also this point which the chairman mentioned, that the Supreme Court itself has from time to time, depending upon its current mood, wavered on whether you should determine taxable income based on true accounting or commercial profits, or you should ignore those and go by the provisions of tax laws. And I think the provisions are clear. The starting point is the true commercial profits. Having said that that is the starting point, which is your accounting profit, the provisions go on to say, however, adjustments can be made to that in accordance with tax law. That's the fundamental principle on which the Supreme Court is based. But there are exceptions to that, where the tax department feels that even the basic accounting principles are not acceptable for tax law, then the first proposal can be given a go by. So you say that normally, and underline the word normally, one would go by accounting profit and make adjustments like 43B or 40A1 or 40A7 to arrive at taxable income. But it is normally, and wherever the tax authorities feel that even the first step is not correct, the tax authorities may ignore even the first step. One may be because the assessee wants it. In a case like Kedarnath Jute type of situation where the assessee goes and says, yes, I have not accounted for this as a liability, I have not accounted for this as a provision, but the fact is I am liable. My wrong accounting can't change my taxable income, so compute my taxable income correctly. And I think the proposition is clearly accepted that just because the assessee has done incorrect accounting, that is not binding. I think that goes without saying. When we say accounts bind, we mean correct accounts bind. If an assessee has done incorrect accounting, if he has not provided for a liability which is liable, that cannot be a reason to disallow. Or if he has not accounted for an income which is his, that cannot be a reason not to include that as his income. So we are talking about correct accounting. So those decisions, there is no real problem. Then comes the decision like a Tuticorin type of case, where, or the State Bank of Travancore type of case, where what seems to be is that the Supreme Court seems to be going against what the accounting profession says. In Tuticorin, the Supreme Court seems to say that the accountants may say that income during the construction period must be set off against expenses, because if you have borrowed money for construction and temporarily lent it out and made money, then that interest is an expense for construction and the interest income must be set off is what accountants say. Supreme Court says accountants may say it, tax law doesn't say that, we will tax this as income. I think almost every time the Supreme Court says something like this, we will really have to reanalyze that provision and see whether we as accountants are making a mistake. And if we are, and I think 9 out of 10 chances are that we are perhaps making a mistake somewhere, and in that case perhaps the accounting principle needs to be revised. As the Supreme Court explained the Tuticorin case in Bokaro, to say that yes, if the two are totally interlinked, then what the accountants say is correct. You can set off the income against the expense. But if the two are not totally interlinked, then you cannot set off the income against the expense. They are two separate transactions. If there were two separate transactions, would even accountants talk of setting off one against the other? And the answer would be no. Even accountants would not have said in an accounting standard for construction that you will set off one against the other. What they mean is that if the whole thing is interlinked. So then we are now left in a factual dispute. Is it or is it not interlinked? If they are interlinked, then the accounting profession is correct and that is the basis of determining income. If they are not interlinked, the accounting profession is equally correct. Even the accounting profession would not set off, nor would the tax authorities set off. That's what it really means. Or take State Bank of Travancore. What was the Supreme Court concerned with? The fact that accountants said that there is an income which is due from a debtor, there is a contract, I am debiting the party, I am saying that last year 100 rupees was due from him, with interest now 110 is due from him, and yet I am saying this 10 rupees is not my income because of uncertainty. So because of uncertainty, I will debit the party, but I will not credit the profit and loss account, I will credit some other account called a suspense account. And the question then was, is this correct? Now AS 9 is clear. If there is uncertainty about the receipt of income, accountants say there is no real accrual at all and you can't account for that income. That's what the accounting principle is. So if there is uncertainty, you should not account for those 10 rupees. And that's what accountants do. The question which the Supreme Court was really asking, if one were to look at it, is, then why do you debit the debtor with 10 rupees? Why do you pass an entry at all? If what you as accountants believe is correct, then when there is uncertainty, there is no accrual. Pass no entry. Don't debit the debtor with 10 rupees. We are not asking you in that case to pay tax in the case of those debtors. But you as accountants are debiting the party, saying that the party now owes me 110 rupees in place of 100, and then are asking the tax department to accept that though I have debited the party, this 10 rupees is not my income. You are now really trying to ask too much. That's effectively what the Supreme Court really, I would say, said in the State Bank of Travancore. They haven't done away with the principle that in the context of uncertainty there is no accrual. And that's really the question. Therefore, one will perhaps have to, in some of these cases, perhaps when one analyzes it deeper, one may find that to some extent the accounting concepts need to undergo a change. And in certain situations, of course, the Supreme Court or the tax concepts may have to undergo a change if they have been incorrectly understood in that context. I think I will deal with specific issues later in that sense. We have one issue which I have raised here in the second slide is, can we really have separate sets of accounts? And I've just mentioned it and leave it because that's a question which people do raise from time to time. The question being, can I really say that for the Companies Act, I have one set of books, for the Income Tax Act, I have another set of books, another set of entries, that for the Companies Act, I close my year in March, for the Income Tax Act, I close my year in June, and therefore I have two different figures of profit, both are true and fair, both are audited as being true and fair, both are certified to be true and fair. And both are therefore my profit figures, even though they vary significantly, although one is a profit and the other is a loss. Because in one I have capitalized the interest, and because of that my resultant figure is a profit. In the other one I have debited interest to revenue and my resultant is a loss, and both are equally true and fair. Because accounting seems to suggest that you have the option. Now, do you really have the option? AS 16 says no. In what situations you will capitalize is clear. If it is during construction stage, if it's an expansion stage, if the asset is not put to use, you will capitalize. Elsewhere you will write off as revenue. But am I as an accountant only looking at AS 16? Can I look at US GAAP and say US GAAP says I'll treat this as revenue? So AS 16 itself is incorrect. The correct accounting principle is set out by the US GAAP. Therefore this is revenue. And therefore I am entitled to treat it as revenue in the accounts which I prepare for the income tax department, even though I treat it as capital in the accounts which I prepare under the Companies Act. Can I really have two sets of accounts? I think the first answer is prima facie no. If you are talking about the starting point of the base from which you are going to determine your taxable income, I don't think you can have two sets of books or two sets of accounting entries. There can only be one accounts, one profit, one loss, whatever it be, and that is the starting point. To that you may make whatever adjustments, but you can't say that I have two sets of books. Having said that, there may be exceptions where you can look at two sets of books. What could those exceptions be? Take a statutory provision like 115 JB, which provision itself says you will maintain a profit and loss account or prepare a profit and loss account. Now when the provision says that I will prepare a profit and loss account in accordance with Schedule 6, but does not say that I will adopt the profit and loss account prepared for Schedule 6. It says I will prepare one. Then it implies that I will prepare a second one over and above the one which I have already prepared. And if it implies that I will prepare a second one over and above the one which I have prepared, it could be different. And the tax authorities don't seem to deny that. That is why they have amended 115 JB, brought in the provision to say, yes, it can be a separate profit and loss account, but you will follow the same methods, the same standards, the same principles which you follow in the other one. Unnecessary. I think the simpler thing would have been that you will adopt the same profit and loss account which you have prepared for Companies Act, and if the accounting year does not tally, you will make a pro rata calculation to work out the 12-month figure, rather than to say that you will prepare a second set but follow all the same principles, still giving me a chance to find something which is different. For example, can I now still say that for depreciation, because I am preparing for 115 JB, a new set of accounts, can I every year start from the figure of original cost and depreciate it again? I will follow the same method, the same rate. No difference in method, no difference in rate. But can my base of cost be different? One for the Companies Act and one for the Income Tax Act. Every year going back to the original cost for Income Tax Act Because Income Tax Act doesn't assume any continuity. It's from year to year. And each year is a separate year. And each year I have to follow 115 JB and prepare a set of accounts. So each year I start from the cost figure, depreciate it for that year, and again start from the cost next year. Where is there a continuity in that sense? So why do they want to do that? But that's what the provision says. As I said, it doesn't say the simpler thing which it could have. Turning to the specific standards, we have the first one dealing with AS2. And the question which I'm trying to raise there are twofold. One is this method of valuation of inventories binding for tax law? It is now mandatory for accounting. What is mandatory is basically including the primary cost. I don't think there can be a dispute. Whatever method of accounting you follow or whatever logic you follow, it is part of cost. Then to that you have to add overheads. There could have been some dispute, but after BSc Footwear and British Paints, etc., I don't think there can be a dispute that I will not add overheads to the cost of inventories. But there can be a question of what overheads I will add. Will I add the variable overheads or will I also add the fixed overheads? And when I come to fixed overheads, even accounting seems to suggest I will add the fixed overheads of production, but I will not add the fixed overheads of office administration, for example. Why? Again, the standard is not supposed to explain everything and does not. But the standard does not therefore really give you a reason why. You will add production fixed overheads, but you will not add administration fixed overheads. If you are saying that you will add production fixed overheads because they contribute to bringing the inventory to its present location and condition, then I think even administration contributes. Because the factory can't run unless there is an office which administers the company as a whole. So therefore to say that office administrative overheads will not be added may not be absolutely correct in that case. So the question is on the accounting principle itself in that sense. But from a tax angle, can I therefore say that I will take the primary cost in the variable overheads, but I will not take the fixed overheads? Can I deviate from AS2? And of course that brings me back to the same question, can I have two sets of books? Because if I can't have, this is a non-question. Because if there is only one set of books, then AS2 is mandatory in respect of that set. Because AS2 is mandatory, the figure of valuation is determined. Because that figure is determined, that is the figure even for tax law. It is only if you accept that there can be a separate set that you will also accept whether there can be a different method of valuation. So really it seems to be a non-issue. But assuming that you agree that there can be two separate sets, then this issue may arise. It may also arise in a slightly different context, and that's the other question which one is asking. Till last year, before AS2 became mandatory, and last year I am talking about the year in which AS2 became mandatory. Till the year before that, I was preparing my accounts including only variable overheads. The tax department accepted that inventory valuation as being correct. I was assessed year after year, and the tax department had no dispute that my method of inventory valuation was wrong. Now because of AS2, I have to add fixed overheads to the inventory valuation. So I have added. Can I not, for purposes of my computation of income, make an adjustment and say that profit as per P&L account, add inventory and less inventory to as per tax law, to show that I am now entitled to go back to the method of valuation which I was adopting in the past? And why should the tax officer reject it when till last year, for the last 30 years, he accepted my method as being absolutely correct? When for the last 30 years he accepted the fact that I was valuing on LIFO, and he felt that because I am a jeweler in gold, LIFO is an acceptable method for me. Now because AS2 says it's not acceptable, how can the tax officer depend on that to say it is not acceptable? Is that something which he can rely upon? Is that a basis on which he can reject my books? Or alternatively, I am a non-corporate assessee and therefore I can take the risk of violating the standard, and I violate the standard and continue to value on LIFO. At the most, the auditor will qualify. But beyond that, nothing else will happen to a non-corporate assessee. A corporate assessee can't do it because the directors will go to jail. But a non-corporate assessee can dare to do this. So he will continue to do this. Will he be entitled to do this in a situation like that? Is the question which one raises. Turning to AS4, which perhaps is the most crucial difference between accounts and tax, and that is the question of to what extent are contingent liabilities deductible in tax law. Prima facie, the answer is no. But if that is true, then why do accountants insist on a provision for contingent liabilities? Both of them are talking about real income or commercial profit. How is it that accountants say that unless you make a provision for contingent liabilities where it is required, and AS4 insists that you make a provision where it is likely and the amount can be estimated with reasonable certainty? If that is what accountants say, then why is it not equally relevant for tax law? But the Supreme Court consistently seems to have taken the view, categorically observed, that contingent liabilities are not deductible for tax purposes. So we have a clear dichotomy here, that while we talk of real income, we talk of commercial accounting, we say commercial accounting with one exception, to the extent that commercial accounting considers provision for contingent liability as a necessity. That is not a necessity, not only not a necessity, that is prohibited for tax law. Having said that, what you do need to realize is that there are very few real contingent liabilities. The way the Supreme Court has tried to therefore analyze it and rationalize it is to try and say that everything which we really call contingent is not contingent. So while the principle is that you cannot provide for contingent liabilities, there is virtually nothing which is contingent. Gratuity, always considered to be a contingent liability, Supreme Court says in metal box, if you can do an actuarial valuation, it's not contingent. Leave salary, considered to be contingent in Bharat Earthmover, Supreme Court says, no, consider the fact that he has worked for the year, the leave has accrued during that year, it is no longer contingent. Right or wrong, that's the view which they are taking. Virtually, therefore, there is no liability which is contingent except a specific single dispute. The basic difference is that if you are looking at a thing in mass, if you are talking about 500 employees or 100 employees or all employees, then gratuity is not contingent. If you are talking about a warranty obligation, and that is what the Privy Council has said in Mitsubishi Motors, if you are talking about a warranty obligation on one car, that is contingent. But if you are as a car manufacturer talking about warranty obligations on all your cars manufactured as a whole in the last year, it is not contingent. That is an actual liability. It's only a question of estimating it. So by calling contingent liabilities which are really contingent as not contingent, we get over this problem by really saying they are not contingent in that sense, and therefore we are harmonizing accounts and tax, but for that there would be some difficulties in issues like this. The next standard which has problems is the prior period. The accountant's concept of what is prior period and the tax officer's concept of what is prior period are always different. The tax officer is looking at legal liability, the accountant is looking at matching concept. Having said that, again, are the two harmonizing? And I think we find that they are harmonizing to an extent. You have decisions like Madras Industrial Investment where even the Supreme Court says, yes, normally you would allow in 1 year, but in this situation, looking at the fact that it will distort the accounts, allow it over the life of the debenture. What are you really saying? What you are really saying is that for even tax law, you will apply the same principles of accounting principles of matching. But in gross cases, not every time. Do we apply it regularly? And I think the answer is yes. There has never been a dispute that as far as prepaid expenses are concerned, you can claim the whole of the prepaid expenses for tax in 1 year, but for accounts you try and provide it into 2. If you have paid 1 year's insurance premium in January and your year is ending in March, you treat 9 months insurance premium as prepaid. Would you be entitled to claim that 9 months insurance premium in the tax computation? On the ground that it's already paid, it's an expense, it's been discharged. What is now left to be done? So under the accrual system, under the legal concept of accrual and discharge, it has already become an expense, even though it is not an expense under the accounting concept. And the answer is no. We have been following the same accounting concept even for tax. We are treating prepaid expense as a prepaid expense even for tax, and it is accepted. And the same principle is now being extended elsewhere. So in a sense, both of them are looking at it in the same way, though both may approach it from different angles. Then you have a host of decisions, therefore, which have dealt with this whole issue of prepaid, as to at what situations is it an expense of the year and in what situations is it a prior year expense. As I said, it will vary from case to case, but really the two are trying to find excuses to come together, is how one would look at it. One standard which is creating a significant problem is AS7. Accountants accepted that the completed contract method was an acceptable method. Now the standard is revised and seems to suggest that only the percentage of completion method is the correct method to determine profits from a construction contract. Does it mean that all those who depended upon the completed contract method in all those years when you depended upon it were both doing incorrect accounting and making an incorrect claim for tax purposes? Because in the first place your accounting was wrong. Though the standard on that day did permit completed contract, the standard was incorrect. We did not understand the concept fully. Now we have re-examined and agreed that the standard was incorrect, and only the percentage of completion method is really the method to be followed. If we take that view, then we have of course a problem for the past. If we take the view, as I said in the past, that accounting is an evolving concept and in today's circumstances, percentage is the best way to compute, then you don't have this problem. Question is, today also, can you as a contractor follow completed contract for tax? The same question as I asked in AS2, can you follow a different method of inventory valuation which was accepted for tax? Say in your case, completed contract was accepted. Can you continue to follow that for tax purposes, even though you may not be allowed to follow it for accounting purposes? I would think there is a good case to say that, because if that was something which accountants accepted for so many years, and even today maybe half the accountants may have an argument to say it is an acceptable method, the other half don't agree and the other half are in a majority because they are 51, so the standard has been modified. Doesn't mean that the other 49 are incorrect. So I think there is a logic to say that completed contract is an acceptable method, is one of the ways in which profits can be determined, true profits can be determined, and therefore for tax purposes this should be accepted. So I think there is a possibility of being able to continue to follow it for tax, subject of course again to the problems of getting qualified accounts and things like that, and two sets of accounts and issues like that. Issues of when would you say a thing is complete? Difficult, but that's an accounting concept. It's a concept for tax purposes also. At what point of time will you really follow the completed contract method? It's not really a dichotomy between accounting and tax, and I won't therefore really go deep into it, though there could be a variety of ways of putting it. The other issue on accounting standard 7 is it doesn't seem to specifically say what will you do with retention money. Is it or is it not part of the contract revenue? In tax law, you have decisions which have accepted that retention money is not revenue. You have a decision of the Calcutta High Court in 179 ITR 8 Simplex Concrete, for example, which takes the view that retention money is not revenue. For accounting purposes, would you be correct in accounting for a construction contract excluding retention money? I doubt that. I think your revenue will include the retention money, though as I said, the standard neither categorically says you will include nor categorically says you will exclude. It is silent on this aspect of the matter. When it comes to tax law, can you argue this? I think the answer is yes. Can you do that therefore even in accounts? Here there is a 50-50 chance. Since the standard is silent, maybe your auditor will agree with you that even for accounting standard 7, retention money is not part of your revenue from the contract. But as I said, it depends entirely on how your auditor will interpret that particular standard. I personally would interpret it to say that retention money is part of the contract revenue in that sense. Then coming to revenue recognition, where you could have a variety of issues, but as Pinakin raised the issue in the context of maturing income, which the department is looking at in the context of, say, deep discount bonds. AS9 may not permit you to recognize the revenue. At least AS13 will not, because effectively what you are doing on a deep discount bond is revaluing it if you are adding the interest element to the amount of the bond. So there may be a question whether it is correct accounting. The circular seems to suggest it is correct tax. Is the circular right? And I think I would agree with the doubts which Pinakin raised. One doubts the validity of the circular. It seems to go beyond what the jurisdiction of the CBDT is. It seems to go beyond the law in that sense. And it cannot change facts. It cannot convert a long-term asset to short-term. It cannot ask you to account for interest income which has not accrued. So, but what is the easiest way? You can't afford to litigate with the tax department. You can't afford for every small DDB holder, if your assessee, to go to the High Court and the Supreme Court. So you have no choice but to follow the circular. Till somebody for whom the stake is big enough challenges it and gets the circular struck down and the law is amended retrospectively. And on that day you will be right because the law will be amended retrospectively and your having followed it will be proved correct and others who have not followed it thinking that the circular is wrong will be held up. So I mean practically while I would not agree with the circular, I would say one is compelled to follow it. Now here is an instance where if you try to follow the circular, you will be hauled up by accountants. And if a company therefore tries to do it, as I said, its directors will go to jail. So the company can't do that because it can't violate the accounting standard. It will have to include this income separately outside the accounts for the tax purposes so as not to fight with the tax department. The other issues on the uncertainty ground I have already discussed in that sense in the context of State Bank of Travancore. The other issue is, one interesting issue is in the number of revival of sick companies which are coming up and therefore the question of write back of loans on capital account. This is not perhaps an AS9 question, more accurately an AS5 question. It's an extraordinary item. Should it go through the profit and loss account? And if it goes through the profit and loss account, is it subject to MAT? In a sense, it is the same question to some extent as on deferred tax which Pinakin raised. If I account for deferred tax as an asset, will it go through the P&L account? And if it goes through the P&L account, will it again be liable to MAT? Both of them are similar questions. On the write back of loans, what is the correct accounting principle? A for MAT, and if you say that it has to go through P&L, even though it's on capital account, it will be liable to MAT. Will it also be liable to normal tax? Is it income under 28(4)? To the extent of interest which you have claimed, there is no dispute. 41(1) will apply. It will be income. But what about the capital component? Is it income under 28(4)? Is it a perquisite or benefit or amenity arising from business? It's a question mark. I would think the answer is no. It doesn't arise from business. It in fact arises from not being able to do business. It arises from the concession which the banker is giving, and therefore it is not taxable under 28(4). But that's certainly an area which one needs to consider. AS12, the accounting for government grants. Again, the accounting standard uses the words related to, whereas PJ Chemicals would allow you to take a much tougher standard for tax law, so you will have a confusion between the two. Accounting for amalgamations has been criticized a lot as having been giving to the accountants a number of total free field in a variety of areas which the tax officers don't like, mainly because of the fact that it has a provision which says that if the High Court directs otherwise, then what the High Court directs becomes the method of accounting. But then really it is the High Court which should be criticized, not the accounting standard. But the point is it is the standard which is being criticized, not the High Court in that context. But that is a standard which therefore, as I said, has been subject to significant criticism. An interesting accounting issue which really arises is in respect of amalgamations after 1498. If I take over a merger company after 1498 and the transferor company has a self-generated brand, can I revalue that brand on an amalgamation? If I make it an amalgamation in the nature of purchase, even the accounting standard permits me. If it's in the nature of merger, the accounting standard doesn't permit me. But I can easily make it in the nature of purchase. I can violate one of the conditions. It will become an amalgamation in the nature of purchase. And in any case, I can go to US GAAP and say, US GAAP now says only in the nature of purchase is correct, in the nature of merger is not acceptable, so I am following a better standard, is what I could possibly argue. So I can do that. If I value that brand on a merger which I have done after 1498 and take a self-generated brand and make it my asset, can I claim depreciation for tax law? Is it now a depreciable asset which I have acquired after 1498? And is it an intangible asset which is therefore now eligible for depreciation? That's a more difficult question to answer. Looking at the definition of written down value and the concept of block and 43, I think it's a difficult call, but not an impossible call. Something worth trying if the stakes are big enough, because the depreciation claim may be worth it. At worst, you will not get it. In any case, otherwise you would not get it. So don't base it on that, but certainly worth trying if you are doing a merger in that type of situation. We have already talked of retirement benefits and the treatment which the Supreme Court dealt with of Bharat Earth Movers. We have dealt with borrowing costs to an extent. The only difference now is 3613 is what was really required was the standard had to change. interest is not a cost of the capital asset. It is only in the Indian context because of the peculiar way in which our industry is, where interest was at very high rates and industry could not bear the cost of interest in the initial years, that we accountants evolved a loophole. And the loophole given to our industrialists in India was, you can capitalize the interest. Otherwise, interest is revenue. Universally, world over treated as revenue. We devised this loophole for them. We allowed them to capitalize. And of course, they continue to claim it as a revenue expenditure in income tax. Now what happens? Interest rates have come down, things have become normal. It is time that we amend the accounting standard. But before we did that, the tax law has amended and said, we will now capitalize the interest. If you have done that in accounts, we are going to do the same for purposes of tax law. So the two are harmonized, and the tax law has also taken the wrong stand, which the accountants were adopting till now, and that's what 3613 is effectively saying. Of course, we need to see to what extent 36313 will go, because it uses the word extension. It doesn't use, and again, when a section is against you, you are bound to try and do some degree of hair splitting. So on hair splitting, whether expansion is extension, whether a new machine is extension, or whether only a backward integration is extension, or a forward integration is extension. And therefore, you might come to a conclusion that 3613 as amended will still apply in a narrow context of backward or forward integrations, and will not apply in other contexts, in which case it may not be so much of a problem. You have the issue on segment reporting, and that brings a question which is slightly different. It is not a question of dichotomy between accounts and tax. The question which I am raising here is, and it's, I think, a fair question to raise, whatever our government may feel, is our tax department mature enough to handle the current accounting standards? What are accounting standards? They are information. As we put it in Gujarati, Vandran and Nisarni apiye છીએ. Now, are they really mature enough, or are they going to use this? Because you are giving information which they may not be mature to handle. So are they going to use this segment accounting and reject all my 8I IB claims and 8I IA claims and say that this segment of yours is not a separate segment, therefore it is not, or the profit shown in your segment accounts is different, and I am not going to accept it. So you are going to have significant problems coming out from segment accounting, which you will have to deal with the tax department. In fact, one of the questions which I have been asked to answer at the end, and I'll just take that here, is therefore the same, that if the tax department representative is sitting on our accounting standards board, why is it that occasionally the CBDT gives clarifications contrary to our accounting standards? And should not there be a situation where in all cases the tax department gives the same clarification? I think that's the way it should be, because if they are sitting there, otherwise they should not allow the standard to be issued. The accounting concept, the standard is clear. So even if it's, though the legal ownership is with the lessor, treat it as if it's purchased by the lessee. That's what you would do in accounts. Will the tax department be entitled to now take the same view for tax purposes? And can they refuse depreciation to the lessor? Worth considering. My own feeling is that they can't. Here is one of the few issues where the observations of the Supreme Court that they are bound by the law will equally govern, and under the law, if the lessor is the owner, the lessor is entitled to depreciation. Will a concept like Podar Cements come in, and would you say that in a finance lease, the lessee is the virtual owner? I don't think the rights of a lessee in a finance lease are the same rights which the purchaser had in a Podar Cements type of case, where in the context of immovable property, the purchaser virtually had all the rights of an owner except the title. That's not true of a finance lease. The lessee does not have same amount of rights, and therefore it may not be held to be the owner. A question on AS 21 is, today we are giving them as additional information, consolidated financial statements, but we are expecting to amend the Companies Act and make that the accounts. If those become the accounts, then will those be the accounts for purposes of MAT, or will the standalone accounts be the correct accounts for purposes of MAT? What will be the basis for MAT calculation? You may have, for purposes of normal computation, you may still treat the assessee as a standalone entity. I don't think that can be disputed. But for MAT, you may have an interesting question, just as the question as to what will you use for the purpose of dividend distribution. Can I use the consolidated statement to declare a dividend? And if I can, it may become the standard for MAT, so I may have a MAT liability there. AS 22 is an interesting standard. One of the key issues which does arise there is Is the liability for deferred tax itself allowable as a liability, even though accountants now call it a liability and say that a provision for deferred tax liability is a must? If it is a must, then it's a provision. And if it's a provision, it must be allowed as a normal provision in accounting, even for MAT. How can it be disallowed? One of two possible views. It's a provision for tax payable. But deferred tax liability is not a provision for tax payable. No tax is payable. It may never be paid at all. In the year in which the liability reverses, I may have some other loss. So to say that it is a provision for tax payable is not correct. Can it be disallowed as a provision for an unascertained liability? In short, contingent liability. Effectively speaking, isn't deferred tax a contingent liability provision? I think correctly, though we don't want to accept it in the standard, but one day or the other when we refine it further, we will. It is really a transfer to a reserve, it is not a provision. We are only identifying a part of the profits which we say are arising out of a difference in tax computations. And correctly, it should be treated as a transfer to reserve. But today you can't say that, you will have to call it a provision. But I think it's closer to a provision for a contingent liability. There is no ascertained liability. There is nobody to whom that debt is due today. There is no party to whom that check has to be paid either today, tomorrow, or in the future. It's not as if one day or the other it will have to be discharged. It is not certain at all, and therefore to my mind it is a contingent liability and therefore not deductible for MAT, but a question which certainly will involve a significant amount of litigation before it is finally settled. Take the standard on intangible assets. That's going to be another standard which the tax department can significantly use against you. Take all your deferred revenue expenses hereafter. If you account for them as deferred revenue, then that means under the standard of AS 26, you are calling it yourself to be a capital asset. And therefore the expenditure should be disallowed. So all your VRS expenditure should be disallowed if you capitalize it. Whether you can is a question mark. I don't think you can under AS 26. But what about things? And that's one question which I would like to ask on this standard, before I conclude. And that is this, that in the context, the standard says that there are 3 tests before an item becomes a capital asset. You must have, in the relation to that item, identifiability, control, and future economic benefits. Now, in the context of a self-generated brand, the standard says there is no identifiability. There is control. You own the brand. There are future economic benefits. But you can't identify the expenditure. Therefore, write it off as revenue. The Supreme Court has time and again said, difficulty of estimation is no reason not to follow tax law. So accountants may say that because I cannot identify the expenditure, I will write it off as revenue. Why should the tax officer agree? He will say, I'll estimate. Supreme Court has said estimation difficulty is no reason not to apply. So while you will treat a self-generated brand as revenue in accounts, will it now become capital for tax? Now it is not now. This is something which they could have done in the past. But AS 26, will it make them wise to the issue? And will you therefore have this issue coming up? The result of which could be very difficult. Because a part of your advertising expenditure year after year may get disallowed as being expenditure for improvement of a brand as opposed to otherwise. And the last issue on impairment of assets, that is a standard for provisions which I don't think will be allowed ever in tax. It's another contingent liability. Thank you very much for having heard me so patiently. Thank you.
Thank you, Gautam. And before I say anything, let me just make an announcement. 3 names. The first 3 names which came as panel speakers, please keep yourself ready near the dais. One is Mr. Sanjay R. Shah, second Mr. Sanjay Pad, and the third is Mr. Mukesh R. Shah. Each of them may kindly take only 2 to 3 minutes. We are aware that all 3 of you are very happy with the opportunity given, as also that you have addressed all the members here on the dais. You may therefore kindly come to the issue proper. Mr. Sanjay R. Shah. Only 1 or 2 questions, please, not more than 2.
in connection with the paper submitted by Mr. Sunil Dalati, some of the questions that I would like to put forward for the kind consideration of the audience as well as the chairman and the paper writer. Whether provisions of section 143(2) regarding the issue of notice mandatorily will apply to the new provisions of section 153 capital A, particularly after the Supreme Court decision in R. Dalmia's case 236 ITR 480. Second, section 153A does not override section 143(3). Does it mean that findings of regular assessment would remain intact in such assessment? Because the question is because there is an abatement otherwise of the regular pending assessment proceedings which are otherwise going on. Thirdly, is it possible to resurrect the loss which I have not been able to claim while filing my original return of income? I have forgotten to file my return of loss, but now that I have been searched and there is an opportunity for me to file the return under section 153A, can I claim the set-off of that loss which would have otherwise not been available to me? I am fully aware about the Supreme Court decision in Sun Engineering case in the context of 147. But now under the new provisions, when there is an abatement of the already existing, already pending assessments, and it is visualizing that there could be only one assessment, could this kind of loss be allowed to be set off in the context of section 153ABC? So since your chairman, sir, you curtailed my quota to 3 questions, I am sticking to that. Otherwise, there are a lot many questions. Thank you so much, sir.
Yeah, I'm sorry. Yeah. Mr. Sanjay Pad. Sorry, Mr. Sanat Pad, I'm sorry. Yeah. Mr. Mukesh Arsha.
Dignitaries on the dais, of the dais. I have number of queries with respect to Sunil's paper, but since Mr. Chairman says you restrict to your only particular to 2 questions, the first query is with respect to para 7 on page 129 with respect to computation of interest for delayed filing the return of income in pursuance of notice issued under 153A. Now Sunil says, where SSE has filed a return of income in pursuance of a notice issued under 153A, after the due date of filing the return of income, or if he has not filed the return of income at all, then interest will be charged up to the date of assessment as per the amended provisions of section 234A subclause 3. Now my query is, if we read the provisions of section 234A(3), the provision itself is very clear that where the return of income is filed after the due date of filing the return of income, then once the return is filed, interest has to be charged only up to the date of filing the return of income and not up to the date of assessment. So this point may please be clarified. The next query with respect to para 13 on page 135 with respect to application of explanation 5 to section 271(1)(c). Here also, as Sunil says, where during the course of search and seizure, SSE is found to be the owner of money, bullion, jewellery, etc. And if the SSE claims that this money, bullion, jewellery, etc. so found to the previous year for which return of income has not been filed, or if it pertains to the previous year which is to end after the date of search, then notwithstanding anything contained in the provisions of the IT Act with respect to the declaration of in the return of income so filed after the date of search, no penalty under section 271(1)(c) will be levied. Now, I have my view only with the last linings, that why no penalty under section 271(1)(c) shall be levied. Because in any case, if we read this entire paragraph, it has only been stated that where a return of income is filed after the date of search, irrespective of the fact whether it pertains to the previous year which has ended before the date of search or after the date of search, the fact remains that the income is declared once it is detected by the department. And if I remember the Supreme Court ratio of Bikran Tyres case, once there is a detection, even during the course of assessment proceedings, and if the return is revised, the penalty is supposed to be levied. But so far as the explanation 5 to section 271(1)(c) is concerned, the penalty will not be levied only in one case, that is, provided the deeming fiction of section 271(1)(c) explanation 5 comes into play. That is to say, provided the undisclosed assets represented by the undisclosed income or the undisclosed wealth are found to be recorded in the books of accounts or records found during the course of search, or it is otherwise disclosed during the course of 132 for interrogations, then only is entitled to immunity. But I am not able to find this particular highlights in Sunil's this particular para, 13 para. So I am highlighting these views before your honor. And though I have a number of other queries, I am restricting my time to respect the Honorable Chair. Thank you very much.
Thank you very much, Mukesh and Sanjay. Both I can appreciate that you would have a number of queries, but there are a number of queries already possessed by the two speakers. And may I now call upon the speakers to reply to the questions that they have. I am not sure whether they will be able to reply or respond to all the questions, so I have requested them to be selective in the questions.
I am extremely elated looking at the overwhelming response, the manner in method in which the queries have been raised. I will be hurriedly dealing with. Two queries have come, whether it is now necessary to keep and maintain the books of accounts prior to 6 years, and what will happen if records and other assets are found out suggesting investment prior to 6 years. I would be say this is the luckiest situation. First and foremost, law is now very clear. I am afraid why you are raising the doubt. Prior to 31/3/98, no need to keep books of accounts, so there is no difficulty. There is no difficulty at all. I mean, I would go to the extent of saying that you can advise your clients to sell those books of account in Pasti, maintain that yes, these books of account sold all from 1/1/1970 to 31/3/98, and that they have realized 3,500 rupees, credit them in the books of account. Just check that the debit is also there when the books of accounts were purchased. Whether the scrap books of like ledger, I have already said. And second point is that yes, during the course of search, if assets are found out suggesting all investment prior to 6 years, I would say is the luckiest SSE that he had been doing wrong prior to 6 years. Since last 6 years he is sadhu, income tax department will be able to do nothing on him. Next question is, statement is recorded in the course of the search that some documents and cash belongs to Mr. X, which is found from his residence. Then under new provisions, what will happen to X if he actually belongs to Mr. X and if he does not belong to X? See, if the raid is on Y, if it is found out that the document pertain to Mr. X, obviously Mr. X has to file the return on receipt of notice under section 153AC or face the consequences. If it does not belong to Mr. X, Y say it is not mine, X say it is not mine, the onus is on Y to prove that it is not his, it is not X, and it is someone else's. Otherwise, the presumption would be adverse and the additions would be in his hand. SSE is required to file a return of income for all 6 years before the year of the search. But consequence, if he claims, as I already disclosed, if it is nothing found out for prior to these 6 years, AO will be duty bound to issue a notice. Not a single penny found out, not a single asset found out, no newspaper and documents suggesting any unaccounted income or wealth. Even then, I read, as raised by Mr. Chairman, AO is duty bound to issue. The wording in this are shall, and here shall may not be read as may. There are instances where may has to be read as shall, but here AO is bound to issue notice. Same return can be filed, same assessment may be framed, or no assessment can be framed at all. Same way, in the case of a financier, if checks are found out, say 20 checks, and then is it possible that the bank account of the person whose checks are found out can be freezed? My answer is obviously no, mainly because checks are found out, department cannot freeze the account of those person. But if check books are found out, or it is proved, or other surrounding circumstances are available that these checks are effectively controlled, managed or owned by the SSC, certainly a prohibitory order or a bank attachment would certainly follow. XYZ company is a partnership firm, is raided, books of accounts have been seized and cash balance is of 15 lakhs. When the question was asked, the partner says all these 15 lakhs are spent in the assessment proceedings before the revenue authority, and therefore I don't have cash. Two questions have been asked. If the department refused to write the answer, what is the remedy? I would say is the luckiest. If he says that I have spent before the department does not write the answer, it will be possible for him to frequently say that yes, 15 lakhs were lying somewhere else, they were there but department did not find out, now I am bringing them in the books of account. If at all that are the facts, I don't suggest bring unaccounted cash there. In case of a firm, confession statement is already made by one partner during the course of search and other partner did not agree. However, he was made to force to agree. Then how to deal with such situation? We have been advising them that if there is a filling or there are evidences available that you were forced to make a statement, immediately after the search is over, please execute an affidavit. The affidavit should be notarized and should be filed at the earliest possible. Please note, Ahmedabad Tribunal is consistently taking a view that if such type of retractions are filed after 2 years or during the assessment or appellate proceedings, they will not be weighed with that seriousness. All administrative directions are binding. This is with regard to the issuance of search warrant, that all administrative directions are binding to the subordinates. Therefore, when FM says that warrant is to be issued by DG, and if DG does not issue, why not illegal? As I said, these are the procedure laws, administrative directions. Non-obedience to administrative directors makes it irregular but not illegal, and I stick to the view which I already expressed. The next question is that if the search is there in April, not mentioned whether 2003 or 4, whether plea can be taken that the stock is out of current year's income and it will be taxed in the return of income when filed. Very much, that is the answer which will answer to another speaker also, that yes, if the stock belongs to the period for which return is to be filed or for the current year's period, explanation 5 to section 271C will be certainly invoked and non-levy of penalty would certainly be attracted and will be available. There is no time limit prescribed under 153BC for commencing proceedings. Does it mean that other person will keep on wondering forever? Is there anything like reasonable time? Is an excellent query. The situation also arose in 158BD proceeding also, that it is not left to the discretion and desire or sweet will of the AO that he can issue BD as and when he thinks appropriate. The issuance of notice under BD should be in a reasonable time. And what is reasonable time is still to be interpreted, but there is a judgment available. I have lost sight of that citation, that if after the 1BC proceedings are over and during that proceeding he finds out that yes, this does not belong to him but to somebody else, say within 6 months or 1 year time, that should be construed as a reasonable time and the notice should be issued within that time. But say after 5 years of search or 4 years of search, if 158 BD or now 153 AC is issued, the SSC will have certainly ground to argue that it is not issued within reasonable time, and by that time he might have lost the track of those books of accounts and papers for which 6 years period is over. And if that is the case, he won't be in a position to be in worse situation than what he was prior to the issuance of notice. Benefit of explanation 11C, would it be available if the statement is recorded under section 133(1)A or after the search? And I'm very clear in this. You have to read those sections in conjecture and in harmonious position. 132(4) statement deals with during the course of search. Explanation 5 to section 270(11)C very specifically mentioned that the statement must be recorded under 132(4) during the course of search. If the search is concluded, no benefit of explanation 5 of section 270(11)C could be claimed in my view, and that is why we say if you feel, if chartered accountant entry or advice is allowed, kindly ask them to have a prohibitory order. Please request them not to conclude the search and allow the SSC to make a voluntary statement under 132(4). A survey is conducted at the premises of SSC company director under a panic, and regarding statement, according to revised return of income filed, he paid the necessary tax. Reply is very clear. If the return is already filed for the period, as I said, prior to March 2002, and after that, if he says that, yes, I have forgotten, I am now filing a revised return of income, the penalty under section 271(1)(c) is a natural corollary, subject to contumelious conduct, mala fide intention, and the arguments that we have to take at the appropriate level. On page 135, I have said with regard to commission waiver, this is a debatable point certainly. I have mentioned in my paper that CIT has power to waive under section 273 once in a lifetime case. It would depend on facts and circumstances of the case. This will also reply to the queries of Mr. Sanjay R. Shah that yes, even in the 153A, 147 section will still remain, and AO will still have a right to reopen even if there is an assessment order passed under section 153A. Same way, even if order is passed under section 153A for any 1 or more years, CIT will have power to reopen them under section 263 also. Friends, I think I have dealt with the most of the queries. With regard to the other queries, Shri Pinagan Bhai Chairman will be replying, friends. Thank you so much.